All right. Introduction. The smart money concept, all right, is a trading strategy that involves, tracking the trading activities of institutional investors or smart money. Institutional investors are large financial institutions such as hedge funds, investment bank, and mutual funds that manage large amount of money on behalf of their clients. Overall, SMC is a trading strategy that involves tracking the trading activities of institutional investors to gain insight into market trends and make informed trading decisions. Now, let me tell you something about this. This strategy is the same thing that this smart money uses, all right? And this is why they are ahead of the retail traders. The retail traders, they actually trade support and resistance. They trade, double top and double bottom, then kind of sharp patterns. So that is actually what these smart money people, this smart money, this is what they use to take the advantage of the retail traders. So they will just look for where they have their stop loss. So don't worry, I'll be explaining everything for you. I have packaged all this because of you. So as I move forward, as an intraday trader, you need to focus on your 1 minute time frame, 5 minutes and 15 minutes for your analysis of this strategy. All right. So which means that focusing on this 3 time frame is what we need. So while other type of traders focus on higher time frame, like 1 hour, 4 hour, like that. But for the purpose of this strategy, you will only be focused on your 1 minute, 5 minute, and 15 minutes per word analysis, so that you'll be able to open your trade and close it and close the trade, within a day. All right, now let's move to the next slide. Thank you. Thank you. I can see that you are responding. Thank you. Thank you for responding. Thank you for responding. All right. Sorry, please. I think yes. So the first thing we want to be talking about is the market structure. So I'll be breaking down every concept I use to properly trade supply and demand in this course, attempting to make it as simple and detailed as possible. In this first lesson, I'll be going through what I think is the most important concept to grasp. That is what market structure. Structure is perhaps the most important aspect of trading and analyzing the chart. By having a good understanding of market structure, that alone could elevate your trading beyond belief. So in this course, I'll be going over the different types of market trends and structural breaks. All right. So all the in any market, we have these 3 types of trends. So mention the market you know about, either stock, either either metals, any of the market that you know, currency market, indices, volatility, mention them. So these are the components that a market trend has. So we have the first one as the uptrend, we have the downtrend, and also we have the ranging. So I have a lot of examples here to give you a better understanding of what I've just mentioned, which is the uptrend, downtrend, and ranging. And each of these comprise of 4 swing points. Each of these trends I've mentioned, these 3 has 4 swing points. So we have the higher high, higher low, lower high, and lower high and lower low. All right. So now we have the uptrend. Now this is the typical example of an uptrend. So an uptrend is when price is printing a series of higher high. So you can see we have the first high here. The price went ahead to make a high which is higher than the previous one. So we have the higher high. So and creating another higher low, which means the low here, it's not up to the low that is here. So we have the higher low. The price went above. Okay, the price went above this high. So we have another higher high again. We have the higher low, which means this high, is this low is lower than this one. Hope you get what I'm trying to say. So we have the higher high like that. This is a typical example of an uptrend. So you have to understand this So this is an example. Right, now let's go to the downtrend. Here is an example of a downtrend. All right, so just similar to the one I showed you on uptrend, the same thing on downtrend. A downtrend is when price is printing a series of lower highs and lower low. So you can see that this is a typical example of a downtrend. So when we have this as the first high, so you can see that we have the first low here. This high, you know, is not up to the previous high. So you have then we see that the high is lower than this. Then we have another high which is lower than this. So that's what we're trying to say. We have a low here, but this low is lower than the low that is here. So we have a lower low like that. So you have to be able to recognize it. So I'll be showing you also on the chart how it looks like. This is just the normal look of it. You have to see exactly how it is on the chart, on the market. So I'll be giving you example of this. So now let's proceed. We have the ranging market. So this is an example of a ranging market. A ranging market is when price is moving with no direction and just consolidating between support and resistance, which is printing equal highs and what? Equal lows. So that's what we say market is ranging. So it means it is moving either in a neither uptrend nor downtrend. Do you understand? So this is basically what you need to know about the market structure. We have the uptrend, we have the downtrend, we have the ranging market. Okay, so these are one of the important things you have to know about the strategy. Now let's go to the uptrend in reality. You can see that the one I showed you before was very clean, but this is how exactly it looks like in a market. This is how it looks like in a market. So by the time you are able to identify your high, so you can see that we have the first high here. This high here is higher than the one that is here. So you can see that we have a what? An higher high. All right. So you can see that also this high here is higher than this. So you can see how it's happening. And don't forget, now let me come back to this first high here. To this first high here. This high, all right, is that price went above this previous high. So anytime you see price breaking above this previous high, you have to know that the uptrend still continue. All right. So then you keep on looking again. We have another high here. So you wait again if price will break this previous high. So if price can break this previous high, then we are still in an uptrend. So you have to be confirming this before you can know if your market is moving uptrend. All right. So the same thing applies. You have the low, the higher low, higher low, higher low like that. And this is how it looks in the market. So your own is just to identify those swing points. If you can identify the swing points, these are the swing points. You have the swing point here, swing point, swing point, swing point. They are all swing points, which we have the higher and higher low, which means that uptrend has two swing points, and the swing point are the high and the low, which can also be called higher high and higher low. That is the two swing points that an uptrend has. So this is how it looks in reality. This is how it looks in the market. Do you understand? Now let's move to the downtrend. All right. So this is the downtrend we have. When a market is in downtrend, it means that the high, the first high that is being printed in the market, which means that we have another high which is lower than the previous high. Then we have a lower high, which means this high that we are talking about is lower than this high. All right. So the same thing happens, and in a downtrend as well, the low usually comes lower. It keeps on going lower, 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 lower. So we have the first low here. So the next swing point will be the lower low, then followed by the other swing point. So you just have to be very careful. So you have to know when price is continuing an uptrend. Now, you can see that price break out through this channel. Price break down. So looking at when price has broken down here, then you might be thinking that, oh, this is still an uptrend. And what do? Then you just keep on looking for another swing point, which is going to be creating, which is the lower high. I believe you are understanding what I'm saying. Charles, hello, please, do you hear me? Like, yeah, thank you very much. Yeah, I like the response. Thank you. So I'm very happy to hear that. So now let's continue. Don't forget, I'm showing you the uptrend and downtrend in reality as we have them, right? So let's move to the next one, the next slide. Sorry, please wait. So what moves to the next slide? So I'm just trying to. All right. So we have the ranging market in reality. I think I've shown you the ranging market, how it usually looks like, but this is how it looks in the market. So when market is creating the ranging, consolidating, creating equal highs and equal lows. So these are the swing points that we have in ranging market. We have the equal highs and equal lows in ranging market. Do you understand? So that is basically what you need to know. So don't forget, I talked about the uptrend, the downtrend, and the ranging market. So I've shown you how it looks like in reality, how it looks like in the market, and also what you need to identify as your swing point. So your swing point, okay, yeah, two lower I have seen. Which one? Are you talking about, thank you, are you talking about the uptrend? Oh, sorry, about the downtrend? Yes. This is not downtrend. This is a ranging market. I think you can see my screen. Charles, please, this one, thank you. This one is a ranging market. So a ranging market has equal highs and equal lows. Do you understand? So it has equal highs and equal lows. While in the other one we have the lower highs as a swing point and lower low like that. But this one is a ranging market. It's quite different from the uptrend and downtrend. You understand? So I will tell you how to trade all those things, what you need to wait for as a day trader. Don't forget that I said that as a day trader, you will need to be waiting patiently for your time frame, which is 15 minutes, 5 minutes, and 1 minute. You are nothing concerned you about 1 hour or any other thing, because you want to be picking your trade within a day. I want to be opening and closing your trade within a day. All right. So now, yeah, thank you. Thank you. You are definitely with me. Sorry, I'm trying to move to the next slide. I've tried to. Yes. Break of structure. Break of structure. Thank you. You are responding to my message. Yes, I can see. I'm following everything you are typing here. So break of structure. I hope you understand. I hope you understand of the 3 basic market movements was pretty straightforward. Was it pretty straightforward? Charles, hope the 3 basic market structure is pretty straightforward. Thank you. Thank you. Now, this is not much to hit, to be honest. There is no much to hit. To be honest, I'm telling you, there's not much to this, what I've explained so far about the uptrend and downtrend, and the consolidation and the ranging market. There's not much to hit. As long as you can identify your swing point, you are good to go. Don't forget your swing point for your uptrend is what? Can you tell me the swing point for your uptrend? Charles, what is swing point for your uptrend? Yeah, I'm asking. Thank you. So we have the swing points. Sorry, the swing point for your downtrend. Then you should know that. All right. Now that what we have just done is just half of understanding of the structure. So I'm going to teach you now how to identify break of structure. This is important, and how identifying this break of structure is necessary to be able to find trading opportunities, because by understanding the principle of the market movement, you can accurately determine where buyers and sellers are gaining strength or weakness. All right. So there are 2 types. There are 2 types of breaks, and you must differentiate between a continuation break and a reversal break, which is what we call our change of character. So which means a break will either break to continue or it will break to reverse. That's what we're talking about. All right, now let's go to example. Now this is the break of structure, continuation. Now, what happened here? As I said before, when price was moving, price broke to this previous high, then we have another high. So the moment price broke to this structure, then it has confirmed to us that this is a break of structure, which is continuation of the trend. It means that the trend is what? Is continuing. Now, in reality, this is how we see it in the market. So any market you want to trade, be it in ICIC market or any market, stock market, any of them mentioned it. So as far as this market, so we have a kind of structure like this, which is a break of structure in an uptrend. So what do you notice here? You see that price went above this previous high. So I've broken this previous high, then it shows that this is a break of structure, break of structure, break of structure, and continue like that. We have a break of structure. So this is how it looks like. So don't forget with the one I showed you, which was not in the textbook picture, which I showed you, and that one was just, it was even straightforward. So don't be expecting the same pattern on the market. No, market is quite different from the way you will see it in textbooks or in any image form. This out. So that's the reason I'm just trying to put the two so that you can be able to understand the one in reality and the one is just in plain picture. So this is the reality. Now, reversal, change of, thank you, yes, thank you. Hope you are getting everything. I'm very happy to have you, like seriously, I'm very happy. So reversal break, that's what we call change of character. So you can see this as a, which means that uptrend change to what? Downtrend. That's what we're talking about. So the moment when uptrend change to what? Downtrend, or when downtrend change to uptrend, that's what we call a reversal break. All right. Now, how does it happen? Now, let's start from here. Price is moving up, breaking this previous high. All right. We say that this is a very good market structure. Price break through this previous high. True. But unfortunately, what happened was that price now later broke through this swing point of the uptrend, which means that the swing point of the uptrend is broken. Then that indicates to us that truly market is changing direction, which means there is a reversal in the trend. So which means this particular picture that you are looking here shows that the market is moving from uptrend to downtrend. All right. So this is change of character in reality, which is what I talked about, which is similar to this one. All right. So this is the market, exactly how it looks in the market. So you can see that we have an uptrend going up, moving up. We have the price breaking this previous high. So we are making break of structure here. We have another break of structure here. And what happened here? Price failed to break this structure. So we're expecting price to continue to break the structure, but now price failed to break the structure. What happened was that price changed it broke the swing point. You can see that we have the swing point is broken by this candle. This candle has broken this structure here. Then this is a typical example of a change of character, which means that the market is moving from an uptrend to a downtrend. Now, what I've just explained so far, we are coming here, other block. So I'm just trying to come up with the thing that you need to know in my strategy. We are still going to the main strategy, but these are just the fundamentals that you have to know. I can't just jump to the strategy without teaching this one. If I just jump to strategy without teaching this one, you might not understand anything. It might look so strange to you, but by the time I start from the very beginning, then yeah, know that we are going somewhere. All right, thank you. Now, I think you have read this already. Now, we all look at one of the points. Now, we will look at one of the important concepts we utilize to find our precise entry point. So, what exactly is an order block? An order block is a visible spot on the chart where a large order is being placed on the market. You will notice the order being placed, followed by a quick move from that region, leaving behind imbalance, and a structure would be broken. So the structure that will be broken that they said here, it can be a continuation or a change of character. Do you understand? So this is the structure. So it can be in any form. So don't forget that anytime there is order block in the market, indicate that there will be a break of structure. All right. So that is what order block. So that's one of the identity to know that truly this is an order block. Don't worry, I'm still going here in detail, but I'm just doing introduction for you. Now, The candle before that impulsive move is what we call an order block. But I want you to remember that order blocks are essentially area of supply and demand in the market. And we will go over that later in this course. So don't forget, order block. These are the areas that these smart people, these smart guys, this is where they place their order. So this is where they buy. They buy, they sell. So that particular candle where they are placing their orders is what we call their order block. But I want you to remember that the order block are essential. Yes, I've said it. So in area of demand and supply, you need to identify your order block. Failure to identify that might not give you the privilege to know, to see the opportunity that the market is giving to you. So the moment you're able to identify order block in a particular market in a day. So every day we have order block. We have order block every day. You understand? So you need to identify them. And this is where we see opportunities. Now let's continue. Yeah, you are with me. Thanks for responding. Yeah, you respond so fast. Thank you. All right, so then I'm making it too fast. Okay, we have the bullish order block. So don't forget, we have this order block, this red candle. This is what we call the sell to buy candle. This is where these smart guys, they bought here. Massive, this is where they start placing the order for buy. So immediately they have started placing order. What happened is that the candle starts moving, the price start moving, they start to pump the price up. They pump it up. Yes. And what? They leave imbalance. Don't worry, we are still coming there. We are still coming to where exactly the imbalance is in the market and where to find opportunities. So this is basically the order block. This sell to buy candle. This sell to buy candle is what? Is the order block for the bullish order block. So you look for the sell before the impulsive move of the bullish candle. So yeah, same thing with the bearish order block. That's the supply. So that's the area of your supply. So you can't say that this is your supply without order block. No, that is not a valid supply. That's not a valid demand if you can't recognize your order block. So a valid supply and demand must have order block, which means must have either bearish order block or bullish order block. Now let's go to the reality. This is the talking about now. Let's start from here. The place I circled. Yeah. You see that this is a buy to sell candle. So this buy candle, you are going to mark out the body. Mark out the body in a rectangular form. You stretch it like just like as I've done here. Then you can see that there is an impulsive candle here. So which means this is where this smart money are placing, are selling. They are selling massively. So this is the order block. So this is your bearish order block. So your bearish order block is the bullish candle before the impulsive bearish move. Are you with me? I hope you understand that. Yeah, the candle just before a large movement is an order block. Thank you. That's the summary. You have said it all. Now, this is what? Bullish order block. Just the same thing. So you can see that this is the bullish order block. We have the price moving up, and don't forget, I think that anytime we have an order block, there's usually a break of structure. So this break of structure, okay, there was a break of structure here, and we have the bullish order block here. So this bullish order block is a sell before the sell candle before the large movement of the bullish candle. And there's a break of structure. Don't forget, there is a break of structure. Anytime there is this order block in the market, there is a break of structure. Thank you. All right, so we have market inefficient or imbalance. So don't forget, in smart money concept, we have a lot of terms, but in my strategy, we just use few of them, few of those terms and how you can apply them. That's basically what you need. You don't need to know everything, know all the terms. We have a lot of terms in smart money concept, but the one that's going to be profitable is what I'm teaching you. Now, let's go to the next topic, which is the market inefficiency. To avoid any misunderstanding before I explain this, thank you. Before I explain what it is, I would like to highlight the many terminologies that you could be familiar with. We have the fair value gaps. I know that you might have heard that before. Have you heard that before? Yeah, Charles, have you heard fair value gap before? Have you heard it before? Thank you. So fair value gaps, we have the fair value gaps, they are the same as imbalance. So don't worry, I will explain everything. Fair value gaps and imbalance, they are the same thing. All these terms refer to the same idea, although traders use different words to describe it. They are the same thing, okay? So you have the fair value gaps and the imbalance, they are the same thing. To put it simply, market inefficiency occurs when the wicks are separated by a distance or a gap and they don't meet. When there's a distance between the wick of the candle, don't worry, I will explain. You will see everything in the market, the way it is in the market, and also in the textbook form, in the picture format. All right. So an efficient market, on the other hand, is one which the wick do not have a gap between them, and actually they actually meet here. I understand that this may throw you off the boat, all right, a little, but don't worry. I will show you some textbooks and chart examples so you can see what I'm talking about. Thank you. So you can see what I'm talking about. All right. This is what we call inefficient imbalance. We have three candles together. We have, do you know this candle usually happens after the other block. So you have to be very careful and observe where we have. Thank you. So there's an inefficient imbalance. The wicks do not meet. You can see them now. They don't meet. So that's basically what it is. They don't meet at all. They don't meet. This is what we call the efficient price action, which means when the wicks are meeting together. So this is what we call efficient price action. So how do you use them? Don't worry. This is a typical example in reality. So we have the other block, and after the other block, we have the impulsive candle, which is you can see the movement, and leaving what is leaving an imbalance together. So the wick do not meet. So this is where we spot your imbalance in the market. So after the other block, then we have the impulsive move. So that impulsive move leaves that imbalance. All right. So this, after what happened, don't worry, I will be explaining what we are. So price usually comes to fill the imbalance in the market. That's how it has been happening. Market price usually comes to fill that imbalance in the market. So it's very, very essential. All right. So this is more example of the imbalance that is filled. So we have this the other block here, which I indicate with a rectangle. So we have the impulsive move, and this impulsive move left an imbalance. So you can see that there is a wick. The wick of this one and the wick of this next candle is not meeting together. So we have the imbalance is filled up. All right, then price tends to come back to fill the imbalance and start going in the original direction that is going before. So don't worry, I'll be explaining this also in details. All right, now liquidity. And up next, we have liquidity. What is liquidity? And how do we identify them? In simple definition, liquidity is just an area where there is a stop loss and penny orders. Essentially, we are the liquidity in the market. However, that does not mean every single order must be targeted and taken out of the market movers, as some areas are simply not liquidated enough for it to be worth the grab for the institution. Popular areas where retail traders tend to sell their surplus and penny orders are at the level of, we have the support and resistance, we have the double top and double bottom, we have the trend lines. So these are the areas where we have liquidity, and these are the areas that retail traders, this is where they put their stop loss. And this smart money, they will intentionally take out their stop loss. They will liquidate them for the market because that's the area of liquidity. All right. So therefore, these popular areas where retail traders tends to execute their trades, we have a lot of stop losses, making a nice level of liquidity for market movers to target. All right. So now we have a double top liquidity. So we have this. Have you heard about double top before? Double top, please. Have you heard about double top before in the market? So they are essentially, yeah, thank you. So double top. So this is where retail traders, they trade this one a lot. They will say, they want to trade double top. But no, you see what will happen. What happened later, you will see in this course. So this is where they put their stop loss when and then they want to trade it. And what happened? You see that the smart money will take out their stop loss. All right, sorry. So we have, this is double top, this is trend line liquidity. We have the, thank you. We have the double top liquidity. Sorry, this double bottom. I made a mistake here. Please correct it though. Just take note. This double bottom, all right? This is double bottom liquidity, sorry. All right, this is double bottom. So we have a double bottom liquidity. So which means, so what happened here, you can see, as a retail trader, we want to trade this trend line, okay, because he has been saying that price has been rejecting, coming down since all, so we want to sell. So as a retail trader, you would enter a sell at this trend line as has been tested multiple times. So what happened? Let's check. See, the smart money intentionally took out their stop loss and price move in their direction. So the price will first move in the direction of the retailers to motivate them. All right. So, all right. So I think you can understand what I'm trying to explain. Thank you very much. So we continue again to the other one. We have the bottom. So that bottom also, we have the double bottom as well. So as a retail traders, you know what happened. They will take it out and that's all. So you have the double bottom liquidity, and you see what happened to the market. They were taken out. So these are just liquidity. So don't forget the area of liquidity, double top, double bottom, and also the trend line. So that's why retail traders, yeah, thank you. That's the first breakout. So that first breakout usually happens to take out to liquidate the retailers from the market. So price move in their direction to motivate them to continue using this strategy, and it works. But then takes them out. Can you see now? They would have wanted to buy here, but price, they were taken out from the market. All right. So this is double top. You have double top as well. You can see here. So as a retail traders, you see you'll have entered the sell here of big resistance level, but you have to understand this. So these are double top liquidity taken here. Can you see what happened here? It took them out, and that's all. So this is the liquidity here. So these are the areas to pay attention to, where you have to be very careful before you enter them. All right. Now, I will want to be, because I need to record this particular video and I want to send it to you. All right. So I will hope you would like to get the recordings. Charles. That was very good. So I will